Okay, so our mission today is pretty clear. We're diving deep into this really fast moving intersection of artificial intelligence and the financial world. AI isn't just some sci fi idea anymore, right? It's actually driving huge investment decisions and honestly rewriting the rules for the stock market. We're going to look at investing in AI itself and also, the big tech players who are basically building this whole new world.
Yeah, and investing in AI, it's just exploded. I mean, you see it everywhere in the media. Plus, it's becoming genuinely useful across, well, pretty much every major industry. It's definitely one of the fastest growing trends we track. So for you, the investor, the question isn't really if you should pay attention anymore. It's more how do you actually engage with this incredible pace of change.
That's right. And what's really interesting, I think, is getting past the buzzwords and understanding the actual financial core of AI. Its fundamental purpose really is to copy or enhance or sometimes just completely replace human intelligence in different workflows. And that means, boosting efficiency right now, scaling things up in ways that just weren't possible before, and crucially, it's about taking that unpredictable human emotion out of really high stakes decisions. The reach of this technology is just so broad. It's transforming everything. It's not just confined to software companies in Silicon Valley. We're seeing AI fundamentally alter cost structures, productivity, in healthcare, agriculture, manufacturing, even entertainment. When you realize it's getting woven into basically every industry's bottom line, you start to understand why investors are so focused on it.
And this is where it gets, well, really interesting for the markets, I think. Because that speed, that rush to implement things like ChatGPT and other large language models, it's created some intense volatility. Why? Well, the tech is just moving faster than our laws, our ethics, our institutions can keep up. It brings up these really complex financial risks tied to unresolved ethical stuff, like uh, intellectual property fights over the data used to train these models, or programming bias that could lead to, big discrimination lawsuits. And just the sheer power of data surveillance these tools enable. These aren't just philosophical issues, they're potential financial liabilities until they get sorted out.
Yeah.
And that uncertainty, that's fueling a lot of the market turbulence.
Absolutely. And to invest smartly here, you've got to see that AI isn't really its own separate sector yet. It's more like the engine driving growth inside the wider technology sector. So the tech sector itself, that's businesses involved in R&D, distribution of tech goods and services, electronics, software, IT services, the whole lot. And the big names driving this, Apple, Google, Microsoft, they're not just using AI. They're the main architects, the ones funding it, building it, deploying it all over the world.
Okay, let's maybe talk specifics then, the actual architecture, because we hear these terms thrown around constantly. Looking at our sources, it seems the biggest market mover right now is generative AI and the systems behind it. Why should an investor maybe focus on that specific part rather than, say, older machine learning techniques?
Well, because generative AI represents the most immediate and scalable jump in productivity we've seen. This is the tech that can actually produce brand new content, audio, computer code, text, images, which means it has the potential to directly replace some very highly skilled and often expensive human labor. And the engine for this is the large language model, the LLM. What's key for investors is that building and training these LLMs, it's incredibly expensive. It takes massive resources. And that automatically creates this huge competitive barrier, this moat around the companies that can actually afford to develop them. Your Microsofts, your Alphabets.
Right. So the upfront cost, the sheer complexity of building a top tier LLM, that already narrows the field of who can realistically win here.
Exactly. And these models, they don't work in isolation. They rely heavily on other supporting technologies. Uh, Take natural language processing, NLP. That's what helps the computer understand human language. It's essential for search engines, for chatbots, or computer vision teaching machines to see and interpret visual data. That's absolutely critical for things like robotics and autonomous driving, which ties directly back to companies like Tesla.
Right.
So these aren't just definitions from a textbook. They represent distinct potential revenue streams and ongoing development pipelines.
But all that software, all those algorithms, they still need a physical foundation, right? If the real money isn't only in the code, maybe it's also in the specialized tools everyone needs for this digital gold rush. We have to talk about semiconductors.
Oh, absolutely. If generative AI is the gold rush, then semiconductor makers are selling the picks and shovels. And right now, the supply chain for the most powerful shovels, the advanced chips, is highly concentrated. These chips, usually silicon, yeah, they're in thousands of products. But the specialized processors you need for cutting-edge AI training and deployment, the GPUs, graphical processing units, they are in massive demand. And it's pretty inelastic demand, too. This bottleneck in the physical infrastructure, that's a huge reason why semiconductors are seen as such a key industry within the tech sector. Software, hardware, services, none of it really matters if you can't get the basic processing power. And this dependence is a major factor driving some of the, frankly, staggering valuations we see in companies that control that crucial hardware supply.
Okay, so let's put ourselves in the investor's shoes. You want to capitalize on the efficiency gains, the potential profits AI offers, but the landscape is clearly complex. So, do you try to pick the specific company that might win the AI race, or do you bet on the whole ecosystem? Our sources seem to point to three main ways in, each with a different sort of risk level.
Right. So the most direct way is buying individual stocks. You're betting on the companies actually creating the AI tech. Could be the hardware folks like NVIDIA or the software giants like Microsoft who are pushing AI into everything they do. This route offers the highest potential reward, sure, but it also comes with the biggest risk if that specific company stumbles.
Makes sense. Then for investors who maybe want that exposure but don't want to bet the farm on one company, there are exchange-traded funds, ETFs. These give you diversified exposure across multiple AI-related companies all at once, like the iShares Robotics and Artificial Intelligence Multi-Sector ETF IRBO is one example. It covers a pretty broad range. It's a way to play the trend if you believe in it generally, but maybe aren't sure who the ultimate winner will be.
And the third option is mutual funds. These are actively managed funds, like, say, the BlackRock Technologies Opportunities Fund, BGSAX. Here, professional managers are actively picking and choosing investments within the AI space. The key difference is that active management. You might get some expertise in navigating this fast-changing sector, but it usually comes with higher fees than a passive ETF.
Okay, but across all these options, the sources consistently point to one thing: volatility. It just seems to be the cost of admission here. We've established that, yes, demand is increasing, which supports growth potential long term, and AI can definitely add diversification to your portfolio. But that volatility, it sounds like a huge gamble. Are we potentially seeing, I don't know, echoes of the dot-com bubble in 1999 where the hype just ran way ahead of the actual business fundamentals?
That really is the million-dollar question, isn't it? The downsides, the cons, they're directly linked to how fast everything is moving. Yes, volatility means potential big losses. But the really unique risk here is how quickly value could be wiped out by things that aren't purely financial. Think back to those ethical issues we mentioned. Intellectual property, for example. Imagine a leading LLM company gets hit with a massive class action lawsuit. Maybe the claim is their model was trained unfairly on copyrighted material, and they lose. That kind of legal liability could just crush the company's value overnight, no matter how good their current earnings look. Or think about future regulations. Maybe new rules come in about data privacy or how companies can collect and use data. That could force an AI company to completely change its core business model almost instantly. These are really unique, specific risks to this domain that traditional financial risk models might not fully capture.
Which really hammers home the point. The number one thing for investors has to be their own risk tolerance, period. Things are changing so rapidly, you just can't count on long-term stability yet. It feels premature. So yeah, AI has massive potential, but the advice seems pretty standard, yet critical. Diversify. Making sure your AI investments are just one part of your overall portfolio seems like the smartest defense against these kinds of unpredictable legal or structural bombshells. So if betting on a smaller, newer AI startup feels too risky, does that push investors towards the established tech giants, the ones with the deep pockets and armies of lawyers to handle these risks? This brings us nicely to that group everyone's talking about, the Magnificent Seven stocks.
Yeah, their influence is just huge. We're talking Apple, NVIDIA, Microsoft, Amazon, Alphabet, Meta, and Tesla. Just their combined size, their market cap, it shows the enormous power these companies have over the entire global market, the indices. What's interesting is their recent performance context. For a lot of 2025, this group of big tech stocks was actually lagging behind the broader S&P 500 index.
Yeah.
That led to some real questions. Was the era of tech dominance maybe finally fading?
But then September happened, and the whole story flipped. Suddenly, this specific group of stocks started dramatically outperforming the market again. You mentioned the Roundhill Magnificent 7 ETF, MEGS. It's now up almost 20% year to date, easily beating the S&P 500's 15% gain. And this comeback, it feels absolutely tied to expectations around AI.
Let's break down some of the main players in that rally, because it really shows the two key sides of AI investing, the infrastructure and the application.
Okay, on the infrastructure side, you've got NVIDIA, still the biggest gainer this year. Their incredible run is basically a direct result of soaring sales for those specialized AI chips we talked about. They're the essential supplier right now. As every company scrambles to build AI capabilities, NVIDIA is catching the immediate wave of spending.
Right. And then you have the application side. Look at Tesla, TSLA. It added something like a third of its value in September alone. That jump happened as investor focus seemed to shift away from just the EV manufacturing numbers and more towards the company's clear progress in autonomous driving, in robotics, and the sophisticated AI needed for all that.
And even the more, let's say, traditional giants got a boost linked to AI sentiment. Alphabet, GeoGujual, climbed 15% in September. Now, that was partly after a big legal win related to its Chrome browser, true. But the underlying market confidence seems tied to the belief that their huge R&D spending, especially on their LLMs like Gemini, will pay off down the line in profits. And then Apple, AAPL. It rose nearly 10%. Our sources mentioned this was partly driven by signs that demand for the new iPhone 17 was stronger than expected. But also, interestingly, there was speculation noted in the financial press about potential regulatory easing or maybe favorable policy shifts after discussions with the current political administration. In this kind of high-stakes tech environment, even just the perception of fewer regulatory hurdles can boost confidence and push up valuations for these major players.
But, despite this strong rally, despite the current optimism, there's definitely a background hum of caution about a potential AI bubble. It's hard not to see some parallels with past tech frenzies. Jeff Bezos himself reportedly called it the kind of industrial bubble. What he pointed out was how incredibly difficult it is right now to pick the long-term winners and losers from all the companies jumping into the AI space. But here's the counterpoint that supports the current positive mood. Bank of America analysts made a key observation. They said historically, every bubble in history popped by central bank tightening. And the crucial thing is, no major central bank has actually hiked interest rates in the last couple of months. So this period of relative stability on the macro front, combined with surprisingly strong earnings reports from these tech giants themselves, it means a lot of market watchers are finding reasons to stay optimistic, or at least stay invested for the time being.
Okay, so pulling it all together, what does this really mean for you, the listener? We've kind of walked through the whole journey in this deep dive. First, AI is clearly fundamental technology. It's changing industries everywhere, boosting efficiency, altering business models. It's real. Second, there are different ways you can invest individual stocks, ETFs, mutual funds, but because the volatility is high, partly due to those unique structural and legal risks, diversification is really key. And third, the recent big performance jump from the Magnificent Seven. That seems heavily linked to the market betting specifically on future growth and profits driven by AI.
Yeah, I mean, maybe I can leave you with this final thought to chew on. When you look at the U.S. technology sector overall today, the valuations are extremely high. I mean, we're talking price to earnings multiples that, let's be honest, look ridiculous compared to almost every other sector out there. Why is the market willing to pay such a massive premium for tech? Well, a big part of it seems to be the buzz factor these companies generate. Unlike older industries, tech firms are constantly launching entirely new business lines, things that just never existed before. They're essentially inventing new markets. And it's that cycle, that constant, seemingly endless innovation and the promise of maybe unlimited long-term potential that keeps fueling the market's willingness to keep placing these big bets on them.